What's up, investors? This is Chris, and in this tutorial we're going to talk about the 3 main option strategies that I use. They're super simple, easy to understand, and will get you set up in just a couple of minutes. And these are some of the safest strategies as well. For the purpose of this video, I am using Robinhood, but you could use Webull, link in the description by the way. You could use other platforms, the same principles apply. For Robinhood specifically, you will need to have what's called level 3 options trading set up. And to do that, you need to go to the investing tab right here. You scroll down, option setting is level 3, okay? Naturally, it will be set to level 2, I believe, or maybe even it will be disabled. So make sure you have that turned on, and of course you understand the risks that are involved in options trading. Now, if you're buying single calls or puts, you have some experience there, you could potentially lose all of your investment, right? And that is the most dangerous thing with options trading. However, if you're using some of these strategies right here, you're going to be able to minimize some of the losses that you could potentially take and increase your chances of coming out with a profit. First one that we're going to talk about is utilizing what's called covered calls, okay? This is a very simple concept. Now, normally a call option is referring to a contract that allows someone to buy 100 shares of a stock at a certain price. That will be the price that you see right here. For example, $15, that's what we refer to as the strike price. And when you buy a call option, you actually have to pay a premium or, sort of like an extra fee or amount of money to buy that contract, to secure your right to buy 100 shares of that stock at that price. When it comes to covered calls though, this is different from that concept of buying. You're actually going to sell the contract to someone else as long as you own 100 shares of that stock already. So for this demonstration with covered calls, I'm going to use IPOE. This is a stock that I own 1,000 shares in. And on Robinhood, what you do is you go to trade, you press trade options, you select a date that you want to do the contract for, and remember, contracts that are expiring sooner tend to be more volatile, okay? They also tend to have smaller premiums though, so if you want to collect more premium, then you're probably going to want to select a later date and an option that is closer to the current stock price. So just in this example, what I'm going to do here is you make sure you go to sell right here, not buy call. You want to do sell call, okay? And let's just say, for example, I'm going to do $25 call. I want to keep my shares, but I want to get this money. So you want to select an option where the strike price is a price that you think the stock might not reach, okay? But it's still worth your time doing the contract. In this case, I could get, says here the current limit price is 9 cents or $9 per contract. And because I have 1,000 shares, I could do 10 contracts here. But for the sake of this, I'm just going to do one contract. So you press review and it says collateral 100 shares. That means you need to set aside those 100 shares and you're not going to be able to sell those 100 shares as long as this contract is out there. If you want to sell those shares at some point, you're going to have to buy back this contract first, otherwise known as closing a covered call, and then you can sell your 100 shares or do whatever you want with it. By the way, guys, if you don't know what this is, I am part of the Stock Dads Discord group. We do private training, we do stock alerts, educational courses, all that good stuff. Make sure you check out the first link in the description down below, and I'll also have a 15% off lifetime discount. All right, so that's how you start a covered call. Now I'm going to show you what it looks like once you've already had one open. So this is one that I opened a while ago. It's MP $45 strike price call option. And the current value of this contract is 18 cents. I sold this call to someone else at a premium of $1.10 or $110. And so obviously you could see here that the value of this contract went down. That's good because you started the contract and there is a maximum potential of $110 that you can gain. Because in this particular case, MP stock is not near $45 and it's getting pretty close to the expiration date, the value of this contract is going to go down, right? The contract that the buyer is now holding is losing value. Like, think if you were the buyer from their perspective, right? That call option is going down, it's losing money. And on the flip side, because you are the seller, you're going to gain money because that contract is going to probably expire worthless. That's essentially what you want to do when you do covered calls. You want the contract to expire worthless. That way you don't have to sell your 100 shares that is collateral, and you get to keep this premium. And as you can see, it could be pretty decent money, $92 gain right now, possible $110 max gain on this on 100 shares of MP. So if you just have hundreds of shares in your portfolio, you can do this selling covered calls out, and that helps minimize your risk because I'm holding those shares. While I'm holding those shares could go down, they could remain stagnant. But if you do covered calls, then that's like monthly or sometimes weekly income that you could be getting, right? You sell a contract to someone this week, you get $100. You sell a contract the next week, maybe you go a little safer, you choose a higher strike price, but that's lower premium. Maybe you get $50, even $20. Heck, even $5 or $10, right? At the end of the day, hey, it's money, right? And you're not doing anything extra, really. You're just taking the shares that you're holding anyway, especially if you're a long-term investor. You're holding these shares anyway. You might as well get paid for it. Now, the downside to covered calls is very simple. If you sell a contract to someone else and the stock price skyrockets, well, since you're still holding 100 shares, those shares are going to increase in value, right? If MP stock goes from 35 to 45 and I'm holding 450 shares, I'm going to make a good chunk of money, like over $4,000. But let's say along with my 450 shares of MP, I did covered calls at a strike price of 40. Okay, I might have not expected the stock price to go way above 40. I thought it was safe. I thought I would just collect that premium and then start over again the next week, start doing more contracts. But if it goes way above 40, let's say 45, 50, 55, 60, then at that point you're losing money on that contract because maybe you only got 100 premium from those contracts, but now the value of that contract, it might have gone up $500, $1,000 even, if the stock price is way higher than the strike price. All right. So what that does is it cancels out some of the gains in your shares. Because the value of your shares is going up, so you're making a gain there, but you're losing money on the contract you sold out because that value of the contract is going up. And remember, covered calls, you want the value of the contract to go down, expire worthless. So ultimately, it's a good way to hedge. It's a way for you to make a little extra income, but be aware. You're going to have to either buy back that contract at a loss if you really don't want to lose your shares, or you're just going to have to be comfortable with the fact that you're going to be losing on that contract and you're going to have to sell your shares at that strike price. Some cases, if you are already wanting to get out of position, then doing a covered call is great because you're giving someone the right to buy your shares, which you were going to do anyway if you were going to sell at the market, but you're going to get a premium too. So if that was helpful, guys, make sure to smash the like button for us and let's get into number 2 on this list, all right? So the second option strategy, which works well with the first one, we'll talk about the connection there, is selling puts, all right? Otherwise known as doing cash secured puts. All right, so let's say I want to buy 100 shares of Carnival Cruise Line right here. Okay, I could go ahead and do that and buy 100 shares outright very easily. I press buy, put 100 shares, and I got 100 shares of CCL. Instead, what you could do with cash secured puts is you can go to trade options right here, select the date once again, and under sell put, all right, make sure, very important, do not put buy put, you want to put sell put and select, I'll just do 29 put. You can see here, I will get a $60 credit, or the value of that contract is $60, and I want to be seeing that value go down, obviously. Once again, very similar to a covered call. And it's going to set aside $2,900 as collateral. And if you read the order summary here, it will explain you're agreeing to buy 100 shares of CCL at $29 per share on or before April 9th. If you aren't asked to buy CCL by then, you'll keep your collateral and the full $60 credit. When it comes to cash secured put, you want the value of the stock to go up, all right? Because if CCL is above 29, then this put is going to be worthless, right? Put option, normally as a buyer, you want that option to go up in value and you want the stock to go down in value. Here is the opposite. As the seller, you want the stock to go up and you want the value of the contract to go down. That's going to result in a gain for you. So I'm going to show you an example of one that I did on a different stock, BTBT. I opened this contract at $110, 1.1, and right now the current value of the contract is 60 cents. So the value of the contract, the put option, has gone down because BTBT stock has gone up since I did this option. And as we get closer to expiration, the value of this contract is going to go down if BTBT is going to stay above this 15 strike price that I created the contracts at. Right now it's already at a $250 total gain here. So if the option expires worthless, then you get to keep that money, but you didn't get to buy the stock. But if the stock continues to go down, it's below the strike price, then you'll end up buying 100 shares because you agreed to buy 100 shares in exchange for the premium. This is, a good thing if you do want to be an investor in the stock anyway. Like if I wanted to own BTBT, if that stock went down to 15 or 14 or 13, then that would be fine because I was planning to buy 100 shares anyway. Now I get to buy 100 shares, but I also got a premium for it. I got $110 per contract if this does come to fruition. So this is a way for you to get paid essentially for buying stock that you were planning to buy anyway. So if you are forced to buy 100 shares of that stock, then at that point, you could take those 100 shares and go back to strategy number 1 and do covered calls on that. So combining cash secured put and covered call, these two strategies together is called the wheel strategy. And it's essentially like a wheel, right? Because you sell a put on something, you get some premium, you get some money for it, and then you have to buy 100 shares. You could take that 100 shares, sell a covered call, get premium for it, and kind of repeat it, right? You could carry on repeat it over and over. As you get more premium money, you could always do more cash secured puts. So this is a great way for you to kind of cycle your money and get that cash flow going. The downside to cash secured puts is number 1, if that stock goes crazy higher, then you get to keep that premium, but I guess you'll be left wondering, what if I just bought 100 shares of that stock to begin with? I could have made a bigger gain. That's the risk you're taking. Also, the second one is if that stock tanks way below what you expected, then that could be a problem as well. But hey, at the end of the day, if you were doing a cash secured put, you have to be comfortable buying that stock at that strike price. You have to be willing to buy that stock and own it anyways. But just an example, let's say for my BTBT cash secured put, the strike price is 15. I'm getting $110 as compensation, no matter what, right? But if that stock drops to say $10 per share by expiration, and I'm agreeing to buy at 15, then that's automatically a $500 loss. I'm down 500 on that position already. So that 110 is not going to be enough to cover that loss. So that's something you need to consider as well. And the third option strategy that I recommend for beginners is the call debit spread, okay? This is a strategy that is very simple. Essentially, you're buying call options, but you're also simultaneously selling a call option at a higher strike price, okay? So on one hand, what's going to happen is the call option you buy, the lower strike price, if that stock goes up, then that call option is going to increase in value, but you're going to lose money on the call you sold at that higher strike price. So it's a way for you to automatically hedge your call option positions, right? If you just buy a single call option and it goes up, then sure, you make a lot of money. But if that call option goes down, then you can lose your entire position. But what happens with call debit spread is if the stock price goes up, then you're gonna make money still, but you're not gonna make as much as you would if you just had a single call option. If that stock goes down, then this is where the merit of the call debit spread comes in. Because at this point, you're gonna lose money on the call option that you're long on, that you bought at the lower strike price. but you're gonna gain money on the contract that you sold out to someone else at a higher strike price. So it's a situation where you don't gain as much as you could, but you don't lose as much as you could either. So it's a great way for you to play it more conservatively and safer than just a single call option. This is very simple, by the way. You just pick an expiration and you press select in the top right corner here, and this will let you choose multiple options at once. What you want to do is make sure you're set to buy and call, and then choose a strike price. Say, I believe Apple is going to be $140 or higher by May 21st. And before you hit confirm, you're going to want to press sell now and select a higher strike price. In this case, I'm just going to do 150 call. So essentially, I'm saying with this option spread, I believe Apple will be above 140, but I think it will be below 150. I do that confirmation and it'll say call debit spread. It'll have the two that you chose right here, and you can review your order. You press a single spread, all right, and it's gonna say buy to open 140 call, sell to open 150 call. And that's gonna create a debit spread for you. Here is an example. I already did one where I chose $110 call option that I'm long on, but $125 strike price call option that I am short on, that I sold to open. I created this spread at $6.90. All right, that was the cost, and the current price is $11.77. So I could sell this early if I wanted to, or I could wait till the expiration date. But you can see here what I talked about earlier with each option having its own gain and loss. So if I go here and look at the 110 call that I bought to open, you can see this is at a good gain, right? $588. But if you go to the one that I sold, you'll see that it is actually at a loss, right? Because Apple's stock price has gone up, actually past that 125 even. It's at $130 here as of this recording. So I gained money on the long call. I lost money on the call I sold. So you take the gain from the call that I bought and the loss from the call that I sold, you put it together, and that is what it means here with the total return of $487 for that spread. So doing spreads can be a good way for you to still be in the options game. Let's say you're bullish on something, but you still want some protection for the downside. Then you do a spread. All right, guys, now you know 3 different option strategies to do on Robinhood. You have the covered call, the cash secured put, and you could combine those two together, or you can do the call debit spread. I want to know in the comments down below which one is your favorite strategy to use in your portfolio. Until next time, my friends, stay well and invest responsibly.